Hey everyone, Dave here. Today we're going to talk about the case for investing in real estate and why it should be a part of your portfolio. So here's the table of contents. We'll talk about real estate returns versus equities. And then a step further is leverage returns with real estate that you can get. Granted, you can do the same with stocks, and we'll talk about why that's more risky. Steady cash flows and returns of real estate. Real estate is a diversifier. In other words, when stocks are going down, real estate can sometimes go up. The psychological benefits of real estate, the tax benefits, and then finally asking the question, should I only invest in real estate? So since 1870, it's like 150 years ago, stocks have averaged about a 9% return versus 7% for real estate. However, when you factor in depreciation and other tax benefits, and also what investors can do individually, these returns are essentially equal. In fact, talking about what individual investors can do, we can look at a bunch of things. So you can renovate properties to dramatically increase their value, improve property management to decrease vacancies. Real estate is local. You can find pockets of value out there, even in markets that are declining in general. And then finally, converting underperforming real estate investment properties into a new, higher, and best use. And so an example is taking large multifamily buildings in shore communities and converting them into condominiums. Now, it's absolutely true that individual stock investors can increase their returns. Warren Buffett is a great example of this, but the value of stock picking has dramatically decreased over time, and most stock pickers actually underperform index funds and index investing. So again, we can look at. This is a specific example. So, so let's look at an example of growth in stocks and what kind of gains you can get there. So let's say you buy $100 worth of stocks. The price increases by 10%. You can then sell it for $110 and realize a 10% profit. So a very simple example there of what you can get with an investment of $100 in a stock. Now, it's a little bit different for real estate. You can buy an investment property for the same $100 that you spend on stocks. Let's say that you pay a 25% down payment or $25 and then take out a mortgage for the rest. Let's say this is kind of a worst case thing here where when you own the property, you make absolutely no profit whatsoever. Expenses incurred is equal to rents collected. Lots of other things happen during this transaction. You have costs to buy a property. You have costs to eventually sell it. You may build equity. So when you roll all that together, let's say that that costs you another $10 or 10% of the purchase price for all of that stuff to happen. So we look then at your total investment, and that's your $25 plus this $10 in cost is now $35. Just like our example with stocks, let's say you sell the property for $110. So your overall gain is still at that $10, but it only took you $35 of cash to get that 10% profit or $10 of profit. So that translates to a 29% return on your investment in real estate versus a 10% for stocks. And again, I'll talk about this a little bit later. You can also use margin when buying stocks, but it is a riskier proposition. We'll come back to that. Returns in real estate are much more predictable. Rent rarely increases or decreases rapidly. It's a much smoother and more predictable flow of cash. Similarly, the value of individual rental properties tends to slowly increase or decrease. And when we look at standard deviation as a measure of this volatility, it's 22% for stocks versus only 10% for real estate. And so when we look at this kind of volatility, when we look at our previous example, using margin to invest in stocks is more risky because they are more volatile and can actually decline to the point where you get what's called a margin call and actually have to pour more cash into the transaction. Versus with real estate, it's much less risky given that both values and rents either more steadily increase or decrease with time. Real estate is absolutely a diversifier. The correlation of real estate and stock market returns varies over time. Sometimes there is a strong positive correlation when periods of economic expansion and overall optimism are in effect, but other times correlations can be either weak or negative. There can actually be examples of real estate going up in value when stocks are decreasing in value. In fact, here's one on the next slide. High inflation. Many sectors of equities can actually fall in value during periods of high inflation. However, real estate is an example of a hard asset, and these tend to do well during periods of high inflation. For real estate specifically, when high inflation is in place, both rents and underlying property values increase during that kind of environment. Lots of psychological benefits of owning real estate. It's a physical asset. You can look at it, you can walk inside of it, you can bring your friends and family in there. It's very cool to own something that tangible versus stocks. They're generally just numbers on a paper statement. You can express your creativity when designing and rehabbing real estate or figuring out ways to unlock value within it. You can be part of the revitalization of a community. So you can do that by improving old industrial sites, improving distressed properties, or just in general enhancing the economic development of a neighborhood by fixing up properties that are in poor condition. Finally, there's a lot of underserved communities of tenants out there who desperately need housing. These include people who have low incomes, foster kids aging out of the system, monitored housing for autistic adults, and finally transitional housing for a number of groups including returning citizens or substance abusers who are re-entering society. Finally, lots of tax benefits associated with real estate. One of the best is depreciation. We're not going to go into that in detail here, but basically you get to write off a portion of the value of your building for the first 27 and a half years that you own it. And this makes it possible to show a paper loss for tax purposes while realizing an actual gain that is not possible to do with stocks. Most property expenses are deductible for tax purposes. You can do what's called a 1031 exchange to buy a replacement property without realizing a capital gain for the one that you sell. Again, this is unique to real estate. When you're selling an appreciated stock in a taxable account, there's always a gain and taxes to pay with stocks. Finally, for your primary residence, you get to take a Section 121 exemption when you relocate to a new one, and that can be done multiple times throughout your lifetime. There are caps in how much that can be done in terms of the increase, but that's generally well within what each of us might expect to realize when moving from one house to another. So when you look at all this, it's like, wow, there's so many benefits here to real estate. Should I only invest in it at the expense of stocks? And the answer is definitely not. There are many advantages to buying individual stocks. They are essentially cost-free to buy and sell. It's very easy. It is a truly passive investment. Owning it is as easy as a click of a button. And finally, index investing allows investors to automatically invest more in the best companies and invest less in the worst companies. And that is why most index funds actually beat active stock pickers. It's very easy to do. So finally, does that mean, again, that you should invest only in real estate? No. If you look at these and many other benefits of stock, they are also great assets to invest in and should be part of your overall well-diversified portfolio. So that is it. If you have questions, you can send me an email at info@rowanfinancial.com or call me at the number provided below. Thanks.